Hello, welcome back to a brand new video. And today we're going to be touching on standard deviation. I think this was a question that was asked by someone that watched one of my previous masterclass on market maker model, and I really wanted to get back into doing some of the previous masterclass that I used to do, and maybe do like a playlist primarily for ICT and arcane concept, breaking down some of my strategy and doing masterclass style videos. So I think this can be very, very insightful as standard deviation level or standard deviation projection, depending on how you decide to call it or enumerate it, are very, very crucial in regards to identifying potential level where you want to essentially get out of your trade in profit, and sometimes project to anticipate certain reversal level essentially. But today I'm going to go over step by step how to set up your standard deviation levels, and do everything else in between. So if you go onto your chart, you want to go to the tool section, and then we're going to go onto the chart later on in this video. If you click onto the fib retracement tool section option, you will have this pop up, right? And when this pop up, you want to modify some of your levels, right, on standard deviation tool. So you want to have a level that says 0, and a level that says literally you want to type out -1, -1.5, -4. You want to also type up 1, and you're also going to type up -2.5. So essentially, all the level in order technically going to be 0. This is going to be the first level. This is going to be the next level. I'm so sorry, actually. This right here going to be the first level, starting at 1. This is going to be your second level, negative 1, and then -1.5 going to be your following levels, and then the second to last level going to be this one, and the very last level going to be this one. Now the reason why I'm going into this order, where this is 1, right, and this is 2, pardon my writing, and this is 3, this is 4, and then this right here is 5, and this is 6. The reason why I'm going into this order rather than going from like 1, 2, 3, 4, like 2.5, 4, is because we're going in negative projection, right? So we're essentially going from right here 1, 0, 1, -1, -1.5, 2.5, and then obviously -4 as our last level. So when we draw in standard deviation, you're projecting in negative, right? You're projecting for potential reversal. You're assuming price has come from a specific zone, right, up here, and then where you're projecting is negatively back to that zone, right? So this is essentially a mathematical projection where price can potentially go back up to, right? So if this projection lines up with some type of target, it typically adds confluence as to potentially where your take profit is actually going to hit or where it's not going to hit. So for example, if you have an origin of consolidation that you think might be the draw for price on the reversal, if it lines up with 2.5 or 4, for example, standard deviation, it should increase the probability of that essentially being targeted if you have a very, very high quality SMR or smart money reversal. So with that said, I'm going to go over to the next slide, but I hope this right here is an easy, simple enough breakdown as to how to set up your standard deviation tool on your chart. So next up, I'm going to briefly talk about this because this is going to be very, very important. When using standard deviation, it's going to be mainly associated with SMR, which is smart money reversal. And for me, I look at SMR as your distribution, the stage between manipulation and distribution, right? So what we're trading in ICT, if you're really doing it correctly, you're always going to be trading some form of AMD or a form of market maker model. Always. If you're not doing that, you're trading maybe some other model, which ICT obviously has a lot of different models out there. But in my personal opinion, if you really want to be consistent, you need to focus on some form of AMD or Power 3, right? Or PO3, or a market maker model framework. These are going to be probably like the most consistent framework that you can utilize when trading. Now, when utilizing either of these framework, you're going to need time alignment, right? So if you're entering on the 1 minute, you're going to need to look at a 15-minute time frame as POI level where you want to see price essentially tap into or sweep level of liquidity before looking for the reversal. That's SMR, which is essentially the from manipulation to distribution, essentially, or the first stage distribution for market maker buy or sell model. So when you begin having that distribution, right? When you're done with the manipulation, you begin distributing, or you begin the first stage distribution for a market maker model right here. You're going to have specific standard deviation level, right? 0 and 1 is typically going to be associated with a leg of manipulation. And I'm going to go in the next picture and show you guys what it looks like. And that leg of manipulation, once you start drawing your standard deviation level, typically where you want to expect price to reach before giving any sort of like reversal is going to be either standard deviation 1.5 or standard deviation 2.5, negative 2.5 or negative 1.5. And then the final target are always going to be lined up with -4 and -5, always, right? As your final target. Now, if price has much more target beyond that, you really don't what do you want to push your luck unless you already cash out most of your position. Maybe you have a runner running and then you just want to let that essentially extend. You can do that all day long. But in terms of letting most of your position run past, past even 2.5 for me personally, I wouldn't even do that, right? Because most of the time I try to target range that will give me typically like a 2R or max 2.5 or 3R trade. I try not to really go beyond that because I try to keep my trade in a way where I'm not trying to be greedy, me personally. And I understand that this is a very, very safe level, like 2.5 standard deviation. It's a very, very safe level. You come to find that as time goes by, you're going to realize that it's better to catch those low hanging fruit level, like 1.5 or 2.5, because price would tend to reverse heavily, almost every single time. Like I'm talking about 40, 50% of the time, once you pass 2.5, you will almost get to fall, sometimes get in between here, and then you will play around and maybe the market close or even sometimes reverse completely and then do some other thing that you don't expect. So if you're not taking profit along the way, you're going to get probably slaughtered. So very, very important. These are key things, right? If you see a liquidity zone, 15-minute fair value gap or relatively equal levels, some type of origin of consolidation or accumulation zone lined up with this level, and I'm going to show you an example of that as a chart example in a few slides. Please be sure to get out of your position. Now we're gonna talk about how to utilize some of the standards, like some of the use for the standard deviation. Um, so let's go ahead and scroll this. So manipulation and distribution target. So when trying to really focus and honing on how to utilize standard deviation, if let's say for example you come into the morning, you don't really have all these other dotted line that I drawn here, and I talked about this in my market maker model masterclass, is that really what you want to do here, right? If you see origin of consolidation like this or some type of accumulation in London or in Asia, prices left behind, and you see London continuously drop like this, right? So let's say, for example, this is Asia, mostly Asia right here. And then this right here represent maybe London, let's say London plus like we begin entering into New York, right? Let's say 8 until 8:30, 8:50, for example, 8:50. Now, when you see this, you have Asia consolidated and created this kind of like consolidation zone right here. Usually what you can do and how this is one of the way to utilize standard deviation, you can start measuring from the top of that consolidation to the bottom of that consolidation. So start with 1 here and end at 0 here and then extend the deviation level. And on the left side of the chart, so on this side of the chart, you're going to see, obviously you can't see that here, but you're going to see maybe a 50-minute fair value gap. Maybe that's sitting there, or maybe a 4-hour massive fair value gap or 1 hour fair value gap sitting here. And instead of that massive 4 hour or maybe daily fair value gap, you can refine and find maybe like a 15-minute fair value gap that's sitting here. And then if this lines up with 2.5 or 4 standard deviation, right? It can line up with 4 or you can line up with 2.5 standard deviation, negative, right? 4.0 or negative 2.5. Now you can kind of have some type of anticipation. So now if you're waiting for, let's say 950 macro to hit, right? 950 macro to hit, and then price give you your SMR inside of the beginning of the 950 macro, and then it pause price, and by 10 a.m. silver bullet, you get a pullback, and then you continue to deliver. Guess what? It is delivering your SMR here and is using 10 a.m. silver bullet maybe for second stage or first stage distribution to deliver it back to either 2.5 here, as maybe that's one of the final target, or it can potentially go all the way back to standard deviation 4. And then the last leg of manipulation, which would be this one right here, will be where you would draw the bottom. I'm going to erase everything here. The last leg of manipulation will be, which will be this one right here, is where you will measure the one and then you extend zero up here to be able to figure out exactly where the projection gonna land. And as you guys can see, if we leave this relatively equal high here, this will line up around 1.5 does not really have anything lined up, right? But the only thing that you guys can see, almost at 2.5, you can clearly see we have a relatively equal highs right here. On this is another clear potential target for price on the reversal, easy draw right here. And then you would typically say this might be landed, this might be London high, for example, right? Which add another confluence. This might be like a 50-minute buy side liquidity, which makes it even a better magnet for price, right? Because you have a lot of that essentially have liquidity pool resting above this relative equal level as well. And this might be Asia high, this might be the current day high, right? And then this represent also the current accumulation zone right here. And within context, as you guys can see, you can understand why price will be drawn towards this because we have a proper, framework in play here that's playing out, and you have all the sign that's indicating that price is can potentially reverse all the way back to two negative 4 standard deviation. And what you're doing here is building anticipation. Keyword here, anticipation for the manipulation target and anticipation for the draw in the target as well. And that's one thing that you can also add is the SMT with ES or YM. If you have that, so maybe price take out a specific level here on a candle based on specific time that you can measure it with, and then but it does not take it on NQ. Guess what? You have the SMT, or you take it on NQ, but it does not take it on ES or YM. Then you have your confirmation there for SMT as well. So you can add more confluence and stack it up, and then price can deliver that reversal very, very possibly. So, and there's I've seen a very few times where SMT is not sometimes needed for that continuation. So it's all about how you want to build the model that you want to implement. Me personally, I don't always utilize SMT because if everything lines up with time and then I get a unicorn breaker, and it's typically within my window of delivery, I'm going to take the trade, me personally. I don't necessarily have to wait for SMT every single time. So the price action and the key level and then time is more important than anything else for me personally. So with that said, that is essentially some of the ways to utilize standard deviation. You can utilize it on a zone that you consider origin of consolidation to be able to build anticipation for where price can essentially manipulate. This could be your manipulation phase, manipulate down to. Some people can look at this whole drop right here as a manipulation. I would look at this primarily, or even this little phase right here as a manipulation phase. And then the last manipulation legs would be this one right here, right? So you can have a manipulation leg that has multiple sweep right here, but there's only going to be one manipulation leg that's going to essentially confirm the reversal with a unicorn breaker, usually right here, if that's a very clean manipulation leg. That's typically really what you want to see. And if this last manipulation, like for me, another nugget here, does not have a fair value gap, I'll look for the next manipulation leg that does have one. So if this one right here is the next leg that I see that qualify, then I'll look for a fair value gap here. If it does, then I'll really wait for the confirmation here. So if we break here, you probably want to wait maybe for price to pull back inside of this range, 50% somewhere here, maybe around 10 a.m. and give you the continuation rejecting off a key zone here, 15-minute fair value gap, or some type of higher time frame PDRA to align with time, right? To give you the confirmation for continuation, and you can target 2.5 right here, easy draw. So there are many ways that you can utilize that, but you have to put it in context with a model that you already have playing out. You have to put it in context with something that you are already which they already have in play in terms of like your strategy and everything else in between. And that's really how you make standard deviation very, very powerful in the way that you utilize it. So I hope this was insightful. Next up, we're going to go over chart example, and I'm going to break down a chart example for a trade that I taken last week on Friday. I think October the 10th, if I am not mistaken. Today is Columbus Day, so there's a 14, 12. Well, I think it's Friday the 11th actually. Friday the 11th, October 11, yeah. So we are going to go over the we're going to go over the chart and essentially do another breakdown here of exactly how to, one of the ways to essentially build anticipation, and it's also project or target. So here we are in the chart. So I'm gonna draw this out a little bit this way, so we can have some fun here. So as you guys can see, This is Asia session right here. This is part of the Asian session. As you guys can see, the market opened somewhere around here. And as you guys can see, we essentially stayed in this box for the most part until midnight, right? When London was essentially beginning pushing here. But as you guys can see, the high of this Asian range or Asian session consolidation is right here. So what I'm doing is I'm gonna delete this and put it back up again. I draw the standard deviation, I click on the top right here, and I extend it all the way back down to the bottom. Boom. And when I do that, as you guys can see, standard deviation, -4 lands right here. So now I can go on to the higher time frame. I can go to the 4 hour, for example. And as you guys can see, my -4 standard deviation level is right here, right? So on the 4 hour, you want to check what do we have lining up with that, or maybe what is price sitting inside of right now. And as you guys can see, we have a massive 4 hour fair value gap right here that price could be sitting inside, and maybe that could be used for a key level to react off of. Since we trade on a 1 minute, our time alignment is a 15-minute time frame. I like to use the blue for the 4 hours, and I'm just gonna make it a little bit more shady, like this. There you go. So I'm gonna go down to the 15-minute time frame, and we're gonna look for maybe another key level, something maybe price might be using. And as you guys can see, we have also a 15-minute fair value gap right here, lining up with that -4 standard deviation. So I'm gonna click on this, and I'm gonna add this yellow light right there, boom. And we are going to go back down to the 1 minute. And as you guys can see, me coming at this time, if I'm trading 9:30 open, right, and then 9:30 open is like somewhere here, I'm already anticipating like negative standard deviation for looking at Asia consolidation right here. If this is creating a market maker model, this is what I'm anticipating. I can already see this 4 standard deviations is sitting inside of this 15-minute fair value gap, nesting inside of this whole 4 hour zone right here. So it makes it extremely high of a probability. You also want to look at liquidity zone. Right? If you look at liquidity, do we have also liquidity that get taken out potentially? This whole time right here that we have, as you guys can see, we have a 15-minute sell side also right here that get taken out. So past sweep this 15-minute, and this looked to be also a very good level of liquidity. I'm going to put X right here, middle centers. So we're going to make this white. Boom. So we have a 15-minute sell side liquidity here that gets swept, and then price essentially target this right here as potential reversal level. So we sweep liquidity on the 15-minute. We have a 15-minute fair value gap that we rebalancing again, or we tagging again as a final zone here to potentially reverse off of. But mind you, this is what we're anticipating. We don't know for sure yet, but this is what we're anticipating as of now. And then as you guys can see, here we're consolidating right here, and we're also leaving multiple relative equal highs right here, as you guys can see, relative equal highs. So when price eventually reach our level, you want to check for the last leg of manipulation. And here, what's the last leg of manipulation? This high and then this low. So when I draw these standard deviation levels, I'm going to show you guys, right? I'm going to delete this and I'm going to draw it again. I pick the bottom of this and I extend it to the top. So once price deliver the break, which is at 946, which is inside of essentially the 950 macro, we see price played around, and then we rejected off that same breaker again around 10 a.m. So technically you have a really beautiful long that you can get in right here, stop loss behind this low, and then you can either target, like I told you before, standard deviation 2.5, look for something around that standard deviation 2.5. It will be this high right here. And then the final target could be standard deviation 4, which essentially is all the way up here. And as you guys can see, price would take that to the tick at 20,480. And this standard deviation number 4, if it lines up with also like a psychological number or near a psychological number, price is very likely to draw towards that psychological number, which is 20,480 here. Or you can also target, just the relative equal high right here and be done. But for me, like I told you guys earlier, safe haven for me would be this. All right, price simply going to this negative 2.5 and looking for a target near that. It will be this swing high right here, because we have a relative equal level of liquidity here, and I'm done. So this is how you can use standard deviation to project a potentials and then find if 2.5, all right, you have 2.5, you have a, what do you have here? You have potentially this sweep of liquidity and we set up a 4 hour, or we can sweep that and continuously maybe tag this 15-minute fair value gap, which would be way better, right? Price tag that and creates that reversal and it's pausing price and essentially delaying that distribution until when 10 a.m. silver bullet, which is right here. And then once that 10 a.m. silver begin delivering, as you guys can see, it delivering now with speed back inside of this low resistance liquidity that we have created throughout these previous sessions very, very easily. Also, side note, this swing high right here is a London highs. It is also a 15-minute buy side liquidity as well. If you look carefully on the 15 minutes, boom, it's a 15-minute buy side liquidity right here. This is a 15 minutes, looks like a relatively equal highs right here, relatively equal liquidity. We also have a 15-minute buy side liquidity right here. This will be Asia high, this will be London's high, and I think this is currently high, London's high. So you have a lot of liquidity pool resting above these highs right here. It's easy for price to be drawn towards that. So when price reverse, as you guys can see, there's simply bodies and wicks along the way until price sweeps this high right here. Maybe you have a little bit of a fair value gap here, price tag into. And then this is obviously an easy potential final target for anybody trying to maybe hold to that. But again, this will be an ideal representation of one of the ways to utilize standard deviation to anticipate potential manipulation target for first stage distribution or SMR essentially, and also draw your standard deviation for projection for where you want to potentially land your take profit. It helps your eyes gravitate towards the easy, very, very obvious target price might be looking to tag. And then if you have a relatively equal level lining up with that, it makes it just as easy as well. So with that said, this is all in regards to standard deviation. If you found this tremendously valuable, please let me know in the comment section down below what is some of the things that you guys will begin implementing after watching this video. I hope this was insightful. As always, I wish to see you in the next video, and make sure to not forget to subscribe and like the video if you find this tremendously valuable. Again, have a blessed one.